Hello and good morning or good day from wherever you are. We are glad you could join us on this day. We are talking about insurable interest as one of the principles of insurance. Definition of insurable interests. Insurable interest is a legal concept in insurance that refers to the relationship between the insured and the subject matter of the insurance policy. It requires that the person buying insurance prove ownership and that they have a financial or fiduciary interest in the property, event, or person that is being insured. This means that the insured must have a legitimate and significant reason for wanting to protect the property or person and must stand to suffer a financial loss in the event of its destruction or death. For example, a homeowner has an insurable interest in their home because they have spent their money building or purchasing the property and would suffer a financial loss if the home was damaged or destroyed. The owner of a car also spent money to buy his or her car, therefore stand to lose when it is damaged or stolen. How about inherited properties? Can you legally insure them? When one inherits a property, he or she assumes the ownership, care, maintenance, and use of the property and therefore have a legal right to insure the same as their own. When you inherit a car, you also inherit its financial value and therefore you stand to lose financially when they are damaged or stolen. The same applies to any other property whose value can be quantified in financial terms. Insurable interest is a requirement for obtaining insurance coverage and ensures that the person seeking insurance has a valid reason for insuring the property or life and will not profit from its destruction or loss. This principle is an important principle in insurance because it helps to prevent people from taking out insurance policies for illegitimate or fraudulent purposes, such as trying to insure something that they do not have a legitimate interest in or attempting to profit from the destruction of property. Insurable interest requirement for purchasing insurance cover. An insurable interest means that the person insured has an ownership interest. 1. Property insurance. In property insurance, insurable interest is established when the person insured has an ownership interest in the property or a financial relationship with it, such as a mortgage or a lease. This means that the person insured has a stake in the continued existence or preservation of the property and will suffer a financial loss if the property is destroyed or damaged. 2. Life assurance. In life assurance, an insurable interest is established when the person insured has a close relationship with the person whose life is being insured. This means that the person insured would suffer a financial loss if the person whose life is being insured were to die. For example, a spouse, parent, or business partner would have an insurable interest in the life of their spouse, child, or business partner. 3. Health insurance. In health insurance, insurable interest is established when the person insured has a financial relationship with the person whose health is being insured. This means that the person insured would suffer a financial loss if the person whose health is being insured were to become ill or require medical treatment. For example, an employer would have an insurable interest in the health of its employees. 4. Casualty insurance. In casualty insurance, insurable interest is established when the person insured has a financial relationship with the property or the person whose loss is being insured. This means that the person insured would suffer a financial loss if the property or person were to become damaged or destroyed. For example, an owner of a car would have an insurable interest in the car, and a business owner would have an insurable interest in their employees. 5. Financial or contractual relationships. A financial relationship with the property being insured, such as a mortgage or a lease. In instances where the bank loans you money to build a house or buy a car, the bank has a financial interest in the house or car and therefore they have a right to insure the car or the house in your name and their name jointly. This kind of relationship also applies to a lender-borrower relationship, such as when a lender takes out a life insurance policy on the life of a borrower to secure a loan. Many of you who have taken out loans with banks or SACCOs have noted an insurance charge levied on your loan. This charge is the insurance cover that the bank has purchased covering your life to protect the amount they loaned you. 7. Marine insurance. Insurable interest refers to the financial interest that an insured party has in the subject matter of the insurance policy. For example, a ship owner has an insurable interest in the ship they own, while a cargo owner has an insurable interest in the goods they are shipping. The principle of insurable interest is fundamental to marine insurance and is a requirement for a valid insurance contract. It ensures that the insured party has a legitimate stake in the subject matter of the insurance policy and is motivated to take steps to protect it. This helps to prevent fraud and encourages prudent risk management. In marine insurance, the insurable interest can be established in several ways. For example, an owner of a ship has an insurable interest in the vessel, while a charterer of a ship has an insurable interest in the goods they are transporting. Similarly, a cargo owner has an insurable interest in the goods they are shipping, while a shipper has an insurable interest in the safe and timely delivery of the goods. It is important to note that insurable interest must exist at the time the policy is taken out and must continue to exist for the duration of the policy. If the insurable interest no longer exists, for example, if the ship is sold or the goods are delivered, the insurance coverage may be canceled or reduced. 8. Life assurance. In life assurance, insurable interest refers to the financial interest that an insured party has in the life of the insured person. In other words, it is the relationship between the insured and the policyholder, and the financial loss that the policyholder would incur in the event of the insured person's death. For a life insurance policy to be valid, the policyholder must have an insurable interest in the life of the insured person at the time the policy is taken out. This requirement helps to prevent fraud, as it ensures that the policyholder is not taking out a policy on someone's life for malicious or speculative reasons. Examples of insurable interest in life assurance include: a husband has an insurable interest in the life of his wife, as he would suffer a financial loss in the event of her death. A parent has an insurable interest in the life of their child, as their death would cause emotional and financial distress. A business owner has an insurable interest in the life of a key employee, as their death would result in a financial loss for the company. Overall, the concept of insurable interest is an important requirement for insurance coverage and helps prevent fraud and abuse in the insurance industry. On the other hand, someone who does not own a property or have any financial stake in it, such as a stranger, does not have an insurable interest in the property and cannot take out an insurance policy on it. It ensures that insurance policies are not taken out solely for the purpose of profiting from a loss. The next video will be in utmost good faith. Subscribe and click on the notification bell so that you do not miss this and many more. Thank you for watching.